Welcome back to the show, Jane. Today we are tackling a subject that, for the longest time, was considered the vegetables of the investment world. Necessary, maybe a bit boring, definitely not as exciting as the dessert cart of tech stocks.
I assume you're talking about bonds, Joe, because I have to admit, every time I open the financial news lately, whether it's Bloomberg or checking my feed on X, everyone is shouting about yields and the Fed. It feels like vegetables are suddenly the main course.
That is the perfect way to put it. Bonds are absolutely the main course in late 2025. And frankly, if you don't understand how they work right now, you are missing half the picture of the global economy. It's not just about safety anymore. It's about income, and it's about understanding a very weird market disconnect we're seeing right now.
Okay, well, treat me like a total beginner. I know a bond is a loan, right? But beyond that, my eyes glaze over when I see terms like coupon, yield to maturity, and duration. Can we start at square one?
Square one it is. Imagine you need $1,000 to start a lemonade stand. You ask me for the money. I say, sure, Jane, here is $1,000, but I want you to pay me back in 10 years. And because I'm not doing this for free, I want you to pay me $50 every year until then. That is a bond. You are the issuer, the borrower, and I am the bondholder, the lender.
Okay,
That's simple enough.
so the $1,000 is the loan amount.
Exactly. In bond speak, we call that the face value or par value. It's the amount you get back at the very end, assuming the borrower doesn't go broke. The end date, that 10-year mark, is the maturity date. And that $50 payment, that is the coupon.
Why is it called a coupon? Do I have to clip something out of a newspaper?
Historically, yes. In the old days, you'd get a physical paper certificate with little tear-off coupons attached. You'd literally clip one off, walk into a bank, and trade it for cash. Now it's all digital, but the name stuck. So if you're paying me $50 a year on a $1,000 loan, the coupon rate is 5%.
Got it. Face value, maturity, coupon. Easy. But here's where I get lost. I look at my brokerage app and it says a bond's price is down, but the yield is up. How can the price of a loan change? It's just $1,000, isn't it?
This is the single most important concept in fixed income, Jane. It's the teeter-totter. Picture a playground seesaw. On one side, you have price. On the other side, you have yield. They always, without exception, move in opposite directions.
Okay, visualize the seesaw. But why? If I lent you $1,000, why would the price of that loan drop to $900?
Let's go back to your lemonade stand. I hold your bond paying 5%. But let's say next year, interest rates in the broader economy go up. Maybe the Federal Reserve raises rates or inflation spikes. Now, your competitor, Bob, opens a lemonade stand, and to attract investors, he has to issue bonds paying 7%.
So Bob is paying $70 a year on his $1,000 bond, while I'm only paying $50.
Exactly. Now, suppose I want to sell your bond to buy Bob's. I put your bond on the market. A buyer comes along and says, Joe, why would I pay you $1,000 for Jane's bond that pays $50 when I can go down the street and pay $1,000 for Bob's bond that pays $70?
They wouldn't. Nobody would buy my bond.
Right, unless you put it on sale. To make your 5% bond attractive in a 7% world, I have to lower the price. I might have to sell your $1,000 bond for $900. The buyer pays $900, but they still get the $50 coupon, which is now a higher percentage of their purchase price, and they get the full $1,000 back at maturity.
Oh, so the yield is the total return they get, the coupon plus the extra profit from buying it at a discount.
Bingo. That mathematics is why when interest rates, yields, go up, existing bond prices must go down. And conversely, if rates fall to 3%, your 5% bond becomes a gold mine. Everyone wants it, so I can sell it for $1,100. That's a premium.
That makes so much sense. So fast forwarding to today, late 2025, I've been reading in Barron's and the Wall Street Journal that the bond market is weird right now. The Fed has been cutting rates since late 2024, right? So shouldn't bond prices be skyrocketing?
You would think so, logically. The Fed started cutting rates in September 2024. Usually, when the Fed cuts, yields fall and bond prices rise. But we are seeing something that economists call a bear steepener, or just a sticky long end. While the Fed has lowered the short-term rates, what banks charge each other, the long-term rates, like the 10-year Treasury yield, have actually stayed stubbornly high, hovering around 4.15% to 4.25%.
Why is that happening? If the Fed says rates are lower, why is the market ignoring them?
It comes down to two big, scary words: inflation and deficits. The market is looking at the government spending. We have massive deficits, which means the Treasury has to issue a flood of new bonds to pay the bills. When you have a massive supply of bonds, you need to offer a higher yield to attract buyers.
Supply and demand. Too many bonds for sale, so they have to cheapen them, meaning higher yields to get us to buy them.
Precisely. Plus, there is the term premium. Investors are demanding extra compensation for the risk of locking up their money for 10 or 30 years because they are worried inflation might flare up again. We saw inflation stick around 3% for a lot of 2025. It hasn't crashed back to 2% as smoothly as everyone hoped. So even though the Fed is cutting the overnight rate, the bond market is saying we don't trust the long-term outlook yet.
I saw a headline on Bloomberg about Fed independence being a risk factor too. What does that mean for my portfolio?
That's the political noise factor. There have been concerns throughout 2025 about political pressure on the Federal Reserve to cut rates faster than maybe they should. Bond investors hate that. If they think the Fed is letting inflation run hot just to please politicians, they will sell bonds, driving yields up. It acts as a vigilante force. So for you, it means volatility. The safe part of your portfolio might swing around more than you're used to.
Okay, so given this messy landscape, high yields but high volatility, is it actually a good time to invest? Or should I just keep my money in a high-yield savings account?
Great question. Here's the reality. Cash is comfortable, but it has a trapdoor. That savings account rate is floating. As the Fed cuts rates, and they are cutting, that 4.5% or 5% you were enjoying on your cash is going to drop to 4%, then 3.5%. You have reinvestment risk.
So I'm losing that income stream over time.
Exactly. Bonds allow you to lock in these yields. If you buy a 10-year Treasury today yielding 4.2%, you get that 4.2% for a decade, no matter if the savings account rates drop to zero. That is why the pros are saying bonds are back. You can secure a return that beats inflation, assuming inflation stays around 3%, for a long time.
Okay, I'm sold on the idea of locking in rates, but what do I actually buy? I hear about treasuries, corporates, munis, junk bonds. It's a zoo.
Let's categorize them by risk, from safest to spiciest. First, U.S. Treasuries. These are backed by the full faith and credit of the U.S. government. Unless the government collapses, you get paid. These are your bedrock. Currently, you're getting decent yields here, and they are state tax exempt.
State tax exempt? So if I live in California or New York, I don't pay state tax on that income?
Correct, which boosts your effective return. Next level up, municipal bonds, or munis. These are issued by states, cities, or counties to build schools or fix roads. The magic here is that they are usually free from federal income tax too. If you are in a high tax bracket, a 3.5% muni yield might be worth the same as a 5.5% taxable bond.
That sounds great for high earners. What about companies?
That's corporate bonds. You are lending to Apple, Microsoft, or Ford. These are taxable, and they carry credit risk, the risk the company goes bust. Because of that risk, they pay more than treasuries. Right now, in late 2025, investment-grade corporates are doing well, but they are expensive. The spread, the extra yield you get over treasuries, is very thin. You aren't getting paid much extra to take the risk.
And junk bonds?
That's high yield. Companies with shaky credit. They pay a lot, maybe 7 or 8%, but if the economy slows down, they are the first to default. Given the economic uncertainty right now, I'd tread carefully there unless you really know what you're doing.
Okay, so let's say I want to stick to treasuries and safe corporates. How do I actually buy them? Do I go to a store?
You have two main paths, Jane, the basket or the ladder. The basket is a bond fund or ETF, exchange-traded fund. You buy a ticker symbol like AGG or BND on your brokerage app, just like a stock. Pros: instant diversification. You own thousands of bonds. It's liquid. You can sell instantly. Cons: there is no maturity date. The fund constantly buys and sells bonds. If interest rates rise, the share price of the ETF falls, and it might not recover for a long time. You never technically get your principal back at a specific date.
That sounds risky if I need the money in exactly 5 years.
It can be. That's why path number 2 is popular right now: individual bonds and the ladder strategy.
You can buy specific bonds on brokerage platforms like Fidelity or Schwab, or buy treasuries directly from the government at treasurydirect.gov.
How does the latter work?
Imagine a ladder with rungs spaced out. You take your $10,000 investment and split it. Buy a bond maturing in 1 year. Buy a bond maturing in 2 years. Buy a bond maturing in 3 years, and so on, up to maybe 5 or 10 years. Every year, one bond matures. You get your cash back. If rates have gone up, great. You reinvest that cash into a new bond at the higher rate, the top of the ladder. If rates have gone down, no problem. You still have the other bonds locked in at the old higher rates.
I love that. It takes the guesswork out of timing the market.
Exactly. It smooths out the income. And the best part? If you hold an individual bond to maturity, you don't care about the day-to-day price fluctuations. The market price could crash to $900, but if you don't sell, you just wait for maturity and collect your full $1,000. You are immune to the teeter-totters price swings, provided you don't need to sell early.
That distinction, holding to maturity versus trading, seems like the key. With an ETF, I'm always subject to the market price. With the individual bond, I have an exit guarantee.
Precisely. But buying individual bonds is a bit more work. You have to research CUSIP numbers, understand bid-ask spreads, the fee the middleman takes, and usually you need at least $1,000 per bond. To build a diversified ladder of corporate bonds, you might need $50,000 or $100,000 to be safe. Treasuries are easier. You can buy them in small increments.
So for a beginner with, say, $5,000, maybe an ETF is better?
Likely yes. Or there is a hybrid called target date bond ETFs. These are funds that actually do mature. You can buy a 2027 corporate bond ETF. It holds a bunch of bonds that all expire in 2027, then it shuts down and gives you the money back. It's the best of both worlds. Diversification of a fund with the maturity certainty of a bond.
That sounds perfect. I need to look into those. Now, what are the gotchas? What could go wrong in 2026?
The biggest risk remains inflation. If inflation spikes back to 5%, your 4% bond yield is effectively losing purchasing power. That's real yield risk. Second is credit event. If we hit a recession, companies might default. That's why I'd stick to investment grade, ratings AAA to BBB, and avoid the junk, BB and lower, unless you have a strong stomach.
And taxes. You mentioned Munis are tax-free, but for the others?
Interest from corporate bonds is taxed as regular income, so up to 37% federal plus state tax. That hurts. Treasury interest is federal taxed, but state-free. Capital gains, if you buy a bond for $900 and it matures at $1,000, that $100 profit might be taxed differently. It gets complex, so for big portfolios, talk to a CPA.
Okay, Joe. Summarize the game plan for me and the listeners for the rest of 2025.
Don't ignore bonds. The 4% rule is alive and well. You can get solid income. Extend your duration. Don't sit only in cash or T-bills. Lock in these 4 to 5% yields for the next 5 to 10 years before the Fed cuts them away. Diversify. A mix of treasuries for safety and high-quality corporates for extra yield. Consider the latter. It's the best defense against reinvestment risk. Bonds are the ballast in your boat. Stocks are the sails. You need the sails to move fast, but you need the ballast to keep from capsizing when the storm hits.
I feel like I finally get it. It's not just old people money, it's strategic income. Thanks, Joe. I'm off to check out those target date ETFs.
My pleasure, Jane. Keep watching those yields and don't fall off the teeter-totter.
Thanks for listening, everyone. Catch you next time.